Welcome. I'm Catherine Magana here with Greg Carroll, Steve Wolf, and Vince Stefano, where we're here to provide you insights about the markets and planning. So here we are. Today is August 14th. We actually weren't here last week, so we're just going to give you a recap over the last couple weeks. Since the last time we were on air with you, the markets are actually moving up, and we've had pretty some decent returns. Year to date, the Dow Jones, as of yesterday's close, August 13th, is up 5.59, which is up about 1% from a couple weeks ago. The NASDAQ is up 12.44%, which is up about 3% from a couple weeks ago. And then the S&P 500 is up is at 9.95, which is up about less than 2% from a couple weeks ago. But the biggest mover was the Russell 2000. So from a couple weeks ago to now, it's up at 4.39. But hold your breath, because today it's down a couple percent. So every day that those small cap stocks seem to be moving around a lot. But that's kind of the biggest mover we've seen in the last couple weeks. Looks like some of the indications that are coming out, some of the news, the PPI, which is the producer price index, came out, which was higher than expected. So it came in, the annual PPI came in at 3.3 from 2.4 in June. And then we also had recently the consumer price index came in at 2.7 year over year, which is pretty much in consensus. And looking at kind of where we're at with interest rates, as of yesterday, there was a 100% chance that there was going to be a rate cut. But now, as of today, that's at 94% odds that there was going to be a rate cut. So I do think there's a high probability we're going to see a rate cut in September. And there's also talks of more cuts between now and the end of the year, another 25 to 50 basis points after September. So we'll see. I mean, obviously, we keep seeing interest rates. We've had that conversation. Looking at where mortgage rates are at, looks like for August, they're a little lower. They're in between 6.4 and 6.6 range. As of today, it's at 6.5 for the 30-year and 5.74 for 15. But also the applications, though, from last week to this week, they've increased by 10.9% on mortgage applications. So people that were kind of waiting, they're starting to see some movement in the real estate sector. So it's been an interesting year. I mean, those growth stocks and tech stocks, like you mentioned, Vince, tend to go up, and we're seeing that right now, year to date, with some of these numbers.
Yeah, you wonder how high they can go.
I know.
I mean, it seems every single day, it seems like we're up and up and up and up. So I'm sure that you, Vince, have an opinion on that. So.
Well, first I want to start by saying that as of Monday, about 83% of the S&P companies have reported their Q2 earnings, and revenues and earnings beat, and they were up 9.7% year over year. So that's why the markets have done considerably well over the past quarter. And the interesting thing is, I always say, good companies know how to adjust to macro conditions. And the vast majority of these companies on their conference call attributed to, across-the-board gains because of technology innovation. And I don't mean just pure play tech. I'm talking about retail, energy, industrial material, you name it. These companies enhance their corporate enterprise through digital innovation. So I think a lot of that led into what we saw in Q2. So I'm a strong believer now, and I had mentioned on our last podcast that there were a couple of things going on, and the rate cuts is where we're going to start focusing, as well as tariffs. Tariffs are going to continue to stay out there, but since Q2 has now ended, everybody's focused on rates. And it was interesting because Jeff Gundlach, who runs Double Line Capital, which is a huge fixed income firm here in the U.S., number one, thinks that Chairman Powell is too hawkish. Okay, a lot of people think
Which means what?
It means that he's keeping rates too high and should be cutting the rates. Gundlach thinks that the Fed will cut rates 2 to 3 times this year. Mm-hmm. So you had just mentioned that. So that's kind of
So how often has he been wrong? Most of the time, I think.
Well, Jeff is wrong when he talks about stocks, but Jeff is right a lot when he talks about fixed income. So I don't listen to Jeff or anything when he says something about the stock market. But when he talks about the bond market and interest rates, he has pretty good insight into that. And he also talked about inflation and tariffs. And he said an interesting point when asked the question. Inflation happens when the money supply increases tariffs do not increase the money supply. So watch where money is flowing, and about 180 billion has flowed into large cap stocks, whether they're value, growth. They didn't make a distinction. I just read this in the Wall Street Journal, and about 80 billion came out of small cap stocks, and that could be why your numbers are showing that small cap stocks have come down a little bit. But I think between now and the end of the year, if we get multiple rate cuts, you will see a significant decline in yields, both in money funds and CD rates. And as I've said many times, when that happens, the Fed forces investors back into risk assets, i.e. stocks. And you've got billions of dollars floating around in those money funds. You've got billions of dollars coming into the United States. A lot of investment capital from foreign countries is coming in. And now we're seeing numerous companies onshoring supply chains into the U.S. This is incredibly positive for the U.S. and the U.S. economy. So I'm going to say once again to my listeners out there, don't get too conservative, be very flexible, and don't be FOMO. Don't have that fear of missing out and chasing things as they keep going up and up. Start doing things now. Talk to your advisor now. And if you got a lot of money sitting in these yield funds, if they start coming down, get into really good, S&P stocks, because you do a lot of dividend investing. I mean, what's the dividend rate? About 3.5% now in the S&P?
It's less than that.
It's less than that?
Yeah, it's closer to about 2%.
Yeah. About 2%? Okay. I thought it was a little higher than that, but
but it adds to the total return.
Yeah. But you could find 3.5%, 4% dividend yielding companies.
You can.
And
they won't be in the tech stocks though, for the most part that you talk about.
No, but what I'm saying is you really need, between now and the next year to 18 months, you've got to be more heavily invested in stocks if you want to really keep above inflation.
I was reading something just the other day on valuations, and I agree, stocks are definitely the place to be long term. But when you look at PE ratios over
price to earnings
ratio is a good valuation method. But maybe a lot of tech companies do more on price to cash flow or sales or whatever else. But
or price to the stars.
Price to the stars, exactly. There's this chart that I'm looking at that shows the forward 10-year annualized returns of the S&P 500 based on the current PE ratio. Where we're currently at, historically, the average annual return going forward for the next 10 years, 0.65%. So what's that, it is what it is. It's expensive out there. And Steve, you mentioned this a few times that, maybe we're in a new realm of, higher PE ratios than we've traditionally seen in the past. So maybe that's going to play in there. But to your point, Vince, buying some of these dividend-paying stocks, maybe broadening out, get rid of the FOMO. You don't have to chase those big names that you're seeing on TV, the meme stocks, the AI, all the craze that's out there right now. Broaden out and just, find good companies that pay a nice dividend. The P's not trading at these, 20, 30, 40 times. And you'll probably do just fine.
I still think the market is somewhat bifurcated, though, because if you go into the tech area, the PE ratios are extremely high.
Yeah.
But if you go into the rest of the market, not so much. I mean, you talk about the small cap stocks. The small cap stocks have not outperformed large cap stocks in what?
Forever.
15 years, something like that. Which is almost hard to believe because, when you're a smaller company on a percentage basis, you should grow at a greater rate than the large companies, but it hasn't been happening. I think one of these days it will turn, and I think your point is well taken, just so our audience here understands that what you're basically saying is there's not going to be much growth in the overall market over the next 10 years.
Historically speaking, yes.
Based on what you just read.
Right.
Now, that may or may not be correct, but I hear that from more people. But I think it's based on the really large tech stocks being so expensive the way they are right now.
Right.
Not convinced, especially if you're a stock picker, that matters. I think there are a lot of companies out there that are not overvalued. And also you have to take PE ratios kind of with a grain of salt because how fast are they growing? You know, if your price to earnings is at 25, but you're growing at 50% a year, well,
Right.
it's justified.
Right. I think that you're right. As a stock picker, there's plenty of bargains out there that have not kept up. I mean, a lot of companies are down 20, 30% year to date, tech companies and other companies. So, yeah, there's areas to be, but a lot of people that in 401ks, they do the indexing funds and so forth. It's, maybe you want to take a little, a deeper dive into what you're investing in, just so you understand that, you're not overweighted in stuff that's really expensive,
Right, and you
on
hear-
an index basis.
And you hear all the time about, just put it in an S&P index fund and you'll be okay. Well, over a long, long, long period of time, that's true. Over 10, 15, 20 years, that's absolutely true. But I think what you're saying is those stocks that are really highly overvalued, or I shouldn't say overvalued, they're highly valued, may or may not continue to grow at that rate. Yes. So if you're in an S&P index and the index is 55%, in about 10 different stocks, and those stocks don't perform, then, you're not going to do that well. So,
yeah, that's a good point, because those, like the S&P, is a capitalization weighted index, meaning the biggest stocks, the largest companies, are weighted much more.
Well, and that's why instead of maybe being in the S&P 500 weighted index, maybe you go into the S&P 500 equally weighted index, where every stock is weighted the exact same thing.
2% across the board.
Correct. And if what you're saying is true, I think that will outperform the S&P weighted index.
According to this statistic there, I would assume that would outperform at least for a good portion of the next 10 years.
Right. Well, and then there's always, look, AI isn't done. We're still in the beginning innings, and all of its ancillary stocks that do well with it. You're talking about energy. Energy stocks have to do well, or should do well. I won't say have to. They should do well if AI continues to go crazy, because we need more energy to supply these data centers and all that. It has to grow. Otherwise AI doesn't work. Mm-hmm. So I think you were saying it before, it's not just technology stocks. It's other stocks that are now using that technology.
Again, I'm not an indexer. I prefer more stock picking portfolios where you can kind of pick what you think are the better companies. But you have to remember, stocks in the market can stay overvalued for a long period of time. Sure. In fact, you talk to any short seller out there, and shorts have gotten killed because they thought the markets were overvalued, but they kept going up, and kept going up.
Yeah, and the short sellers are betting that
short sellers
will
that
go
the
down.
Stocks are going down, and they're not going down. So again, I want to, it's an interesting statistic point, and again,
it's a piece of the.
It's a piece of the puzzle. It's a great piece of the puzzle, and again, I'm not an indexer, so I always take the opposite side of that and think that it's better to put together, 45 or 50 what you think are some of the best companies out there.
Sure.
And even if you have to overweight them a little bit, because, look at, some of those big mega cap stock companies. When we were down in the dumps in March and everybody thought the market was going down another 25 or 30%, it didn't. And what took us out of that doldrum? Big cap tech stocks. And, these companies are innovating like crazy. And if you said, AI ain't dead. It ain't dead, bro, and it's going to go. Now, all right, I'm going to ask a quick question. I want everybody to answer this. End of the year, where do you think the S&P is? Up how much?
I think
from here?
From here,
January?
right from here. Right now, Catherine said it's up, what, 13%? No, I'm sorry.
Under 10, just under 10.
S&P 500 year to date was up 9.95%. So
where do we end the year?
I think we end the year at 12% in the S&P.
For the full year?
For the whole year, year to date.
That's a good question. For the full year, we're going to be...
Come on.
I'm going to say we're going to end up... we'll be at 15% for the full year.
I haven't the slightest idea.
Where's that crystal ball of yours?
Come on,
I think it will be higher or lower than where we are right now.
Along the way.
Probably the best answer.
What's he, a hedge fund manager now?
I'd be happy if we stayed where we are. But kind of going back to kind of the financial planning, retirement planning, I know we're talking about different... Oh, you want to hear Vince's?
I want to
What's
hear
your
Vince.
take?
My take is if the Fed does cut rates like We think they're going to.
Well, not if.
I'm
What's your number?
my number plus 20.
Really?
Plus
You
20.
don't think they priced it in already? I feel like they've already known.
That's
that
what I'm a
rates-
little concerned about.
I don't
Mine's plus 20
know. Interesting. Okay.
From here or for the whole year?
total.
Oh, yeah.
Total year.
Total
At
year.
the end of the year, the S&P will have made 20%.
Yeah, because that'll be double from what Catherine had
Yeah.
mentioned. Yeah.
Okay.
Okay. So what I was mentioning was from a financial planning and retirement planning perspective, I know we're talking a lot about individual stocks and portfolios, but what we look at though is what's the purpose, what kind of income do you need, and there might be some other investments that we fill in for that. And so it was interesting, some of the things that we look at for some clients, depending on how much money we're managing and if they qualify or an accredited investor, we do have some alternative investments and other things that we consider. But what I wanted to bring up was Trump has signed an executive order for 401ks. And as of last Thursday, he signed an order to encourage in defined contribution plans, which are 401k plans, to invest in alternative investments such as private equity, real estate, cryptocurrency, commodities, infrastructure projects, and lifetime income strategies. So with that, that's a huge change to the 401k platform. And so with that, the executive order states that fiduciaries of the 401k must vet and consider all aspects of these investments. And so these investments are, there's some nuances involved with them. And so it's changing the platform for those that have money in 401k plans. So as we learn more, know more, we'll let you know. But I just wanted to, as we're kind of talking about different investments, I know we're focusing a lot on individual stocks. And then there are times for exchange traded funds. We look at potentially if there's a sector or maybe an area that we want to get exposure. There are times we do look at some exchange traded funds overall, maybe like an international or some other type of investment. But we definitely think that you do need to keep up with inflation. You do need growth, but it is kind of case by case, and each client is very different.
I think that that opens up the window for crypto investments.
Yeah,
I
absolutely.
think that was part of it.
Yeah.
They want those in the 401k as well.
They do.
Yeah.
So we know whether it's things like Bitcoin or Ethereum or any of those, but a lot of the crypto investments I think will creep into the 401k plans.
Oh, totally. Yeah.
So-
I think some of the private investments, they're illiquid, they're long-term in nature. If they do get them in there, it's going to be a watered-down version at best, and it's going to be, one of the things you have to do as a fiduciary on a 401k plan is look at expense ratios, and these things are going to be 2, 3, 4, 5 times as expensive as anything else in the plan, especially these, S&P 500 fund at 3 basis points. Well, you're going to spend 200 to 250 basis points for some of these private
Which is 2.5%.
2.5%. Yeah, I think it's, I don't know. I'm
So
Not so
what
sure
you're
it's a good
saying?
idea.
So what you're saying is either the government's going to come in and say you guys can't charge that much, or they're
Well, it's going to be a watered-down version then, because you can't have the liquidity. The whole idea behind these private investments is it takes time to build them up, and it make them efficient and everything, and sell them off. But I just don't see it working that well in a 401k plan. And I know I've been reading a lot of articles too that big advisors that do a lot of 401k plans are like, how do we vet all that stuff?
well. Plus, you have to be really careful because let's say you move your 401k plan to an IRA or to another company or whatever, and you've got all this illiquid, all these illiquid assets in there. How does that work?
Right. Yeah.
So there's a lot,
One thing to sign the order, the other thing is how do you implement and what are the
Exactly.
rules and
But
regulations.
speaking of the fear and greed index,
I was just going to ask that.
the CNN Fear and Greed Index is right now at 63, which is interesting because it's in the middle of the greed area, which is a month ago it was at extreme greed. And now we've actually gone down. It actually was down even less than that a week ago, and now it's pulled up a little bit. But here we are kind of in the greed section. I would have thought that we would be near 100 in the extreme greed,
I thought
but
it
we're
would
not.
be much higher. Yeah,
But we're not. So that's where we are.
91% of mutual fund managers think the market's overvalued, and or stocks are overvalued. So that could be why this is coming down a little bit.
Who knows? I don't know why.
I'm sorry to interrupt
I just
you.
know what. I don't know the why
I didn't
behind
mean to
it.
interrupt you.
But another thing that happened, I think it was in the last week, and I thought this was interesting. I'd kind of like to get your comments on it. Nvidia and AMD are now able to sell their chips, their watered down chips, to China. However, the deal that they made is that 15% of the sales have to go to the U.S. government. So that is pretty unusual. Catherine's looking at me like,
Wow, that's
maybe she hasn't heard this, but this happened about 4 or 5 days ago.
last week.
I mean,
I don't think it's right.
it's
this administration does everything differently than anything's been done before. I just, how can the government now say get into private industry and that, revenue sharing with them? I don't think
well,
that makes a lot of
they
sense.
do that with taxes.
Well, they're already taxing them,
but this is
and Trump wants taxes lower, right? But this is a tax.
It is.
It's a higher tax.
I find that to be a very unusual,
Contradictory there a little bit. Yeah.
a very unusual.
Yeah, I saw that and I just kind of shook my head. And, I was like, "Whoa!"
Yeah.
I don't know. We'll have to see how that works. I think that granted they're watered down chips, but I also think that anytime you're selling anything to the Chinese Communist Party, I think the government has to have some kind of oversight on that one because
Has to have oversight?
Yeah, they have to have. I think so because
Revenue sharing and oversight, or just oversight?
I think they have to have oversight. I'm not sure about revenue sharing, but and again, I think that we just have to be very careful.
I don't
I think, doesn't that open the door for other companies? I mean, how can you say just you could do it for one business but not all business?
And I don't understand the reasoning behind it. Why? Okay, I'll let you sell this if you pay me. I mean, I've never heard of that before.
I heard something about the conversation when Jensen Huang from Nvidia went in there and to talk to President Trump, and when he was in D.C. last week, and he said there was something about the conversation that was like, all right, Jensen made a good argument to allow these chips to be sold to China. They're not going to give them an advantage or anything, and Trump's like, all right, give us 20%. And the story goes that Jensen's like, how about 15? Done. I mean,
But I still don't understand the reasoning behind it.
I know.
I saw it. And I
It's-
don't understand the reasoning on it.
what if either we should be they should be able to sell those or not, but not taxed higher for it.
Well, I know the money's supposedly going toward our debt, which I hope that all this tariff money and all the stuff that we're talking about right now actually does go to decrease the debt. That would be a real positive.
We just hit 37 trillion.
Well, and that's it. We need to cut that down. Certainly make sure that it doesn't go any higher, but we really need to cut that down. So let's see.
100%, yeah.
Let's see what happens. I don't know.
I'm not so sure. $100 billion in tariffs so far this year is going to make a dent, but we'll see.
Well, it's going in the right direction, I guess. Then.
Yeah.
That's right. All right. So what else?
So the only other thing coming up is we have the One Big Beautiful Bill Act webinar coming up on August 26th at 12 o'clock. So that's going to be on Tuesday, August 26th with Rachel and myself. So if you haven't registered, make sure to register for that. And we look forward to going into more detail about taxes, and that's Rachel's wheelhouse too.
Well, I will not be on that, but I will be on the One Big Beautiful Broker one.
There you go.
I'm getting snide.
You're going backwards. You're a broker again?
You're right.
Yeah. Why not? All right. So that takes care of this week, and we will see you guys next week. Thanks again for listening.
Thanks.
Thank you.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.